Hi, this is Greg Vincent talking with top producer, marketing strategy analyst Jerry Gulke with the Gulke Group at the Chicago Board of Trade. And Jerry, you've been looking at some issues with the corn market here for a while, and go back to a month ago at the marketing rally, and kind of the general consensus there was to make some sales there, and you said to wait. And based on the market reaction since that time a month ago, and looking at what's happening today on the markets, you might have been right on this one. What were you seeing then that we're actually seeing come to fruition now, and are you still seeing those things?
Well, yeah, we were a little concerned back then because of the fact that those of the top producer readers, longtime readers, will note that I do some technical things there that looks at the long-term monthly situation. And back in September, when corn got to $3 and turned around, we had a monthly buy signal, which historically in the past has meant that we have an upward bias in markets of from 12 to 18 months. And of course, since all that happened in September, we had the frost and we had the bad quality and we had all this, and it makes me a little concerned to get overextended on the short side of this market if there's a possibility that we have some unknowns out there. And what we don't know yet is how much grain we've actually lost in the field. And we have a number of acres out there, I think 600,000 acres left. It's under 2 feet of snow and 30 below in North and South Dakota. And even I'm not done in Northern Illinois, second time in my life. But we'll get it out of here about the time we plant. So there is some upside concerns out there that the people that move the markets, the money, also create the little bar charts, the high, low, and last on the charts. And when those things, the momentum starts to turn on that, and you have to be concerned. We did rally nearly 30 cents from that level, and actually today I looked at has been looking at the December corn chart, the far out December 2010, and we got high enough today to where you could probably get $4 a bushel for your corn out of the field next year. And this is the first sale we've made at $4.49 3/4. I looked at the Dees chart, and a lot of people will look at it and take the extreme highs, extreme lows, and say, what kind of a retracement can we get out of this? Can we get half the money we lost back again? And what I did, though, was looked at it from October of 2008 for this far back, looking this far ahead, I guess, in 2010 corn chart. And October 1st, we were at $5.57.5, and we dropped down to about $3.53, about $2 a bushel. And lo and behold, as of this last week or so, we've hit 455, close to 452, and the highest flows we ever had back in the last 6 or 7 months has been 446. And I thought that was an exactly 50% retracement from the October 1st of 2008, and that was more important to me than looking at the extremes at 750, because I think that was an aberration. Then I look at it and try to surmise and say, all right, what's the guy that's going to buy my corn going to do with it? Can he make money at it? And the hog guy is in trouble, and certainly we continue to see corn 30 or 40 cents higher for December 2010, and then you look at the carry for into 2011, and you put more strain on this hog guy to continue to liquidate. He's just going to make less and less money unless futures go a lot higher. So at that level, I said, the guy that's buying it from me at $4.50 a bushel for December can't make a lot of money at it.
As a farmer out there, when you're looking at prices where you can lock in a profit, I mean, this is all part of a risk management strategy, but if you really think they're going to go higher, what kind of things do you do to really at least protect yourself in those situations, just in case, we could be wrong?
Well, my first sales, of course, I use the futures, and I don't want to do it in a big way, because one contract moving 20 cents can cost you $1 a bushel. I mean, $1,000 per contract. And it's great to say, well, I'm going to lock in 450 corn. But what if it goes to $5? Suddenly I've got a margin call, and I haven't even bought the seed to plant the crop yet. So you get, with these prices at these lofty levels, you can make or lose quite a bit of money, and you have to put money with that amount to say, all right, I'm happy with 450 corn, $4 cash, and I'm going to be in the futures market because my basis is terrible, whatever the reason. But I also know that I could be wrong by 75 cents to $1 even. And do I have the margin money there to take it? You need to have that money there. So I try to do initially maybe make a futures or a cash contract. The options are prohibitive. It may cost you 30 cents to buy a put under that, and that means you're willing to take 30 cents a bushel less than what it really is. if you really think it's going that low, then maybe you ought to sell even more if you take that personally. But I try to start bleeding in some cash contracts, and knowing full well that, all right, the market is taking me for a ride for 15 or 20 cents in the basis, but it's a long way out there. I'm going to do some, and I probably would never get more than 40% cash contracted, and then start reverting to something in the order of futures and maybe some puts type of thing. I also look ahead now into the February time frame, and if the world economy improves, like it appears that it is, we may get back the demand that we lost due to the high prices and the speculation supposedly and all that for the previous 2 years, that we went to $7, $8 on corn. I don't know. And again, the dollar today is down pretty hard. It's down 500 basis points, or 0.55 or whatever. I think, again, you got to look at this and say this is a futures market, and what you're asking the market to try to discover is a price for my corn that I'm going to harvest next fall, beginning in September 1st, the new marketing year, and then utilize that all the way around to August of 2011. So we're not talking this year. We're talking far enough out that says, goodness, pumping all this money in the world economy, we may be very well back to where we were before the bubble. And if that's the case, that means 2 to 3% growth in world demand for foodstuff. And can we keep up? And can South America even keep up? And there lies the rub. It's a futures market. It's not a past market. It isn't looking back. It's looking ahead. And if we do, then someone out there who bought the corn that I sold at $4.49 3/4 today thinks it's a good deal, or he wouldn't have purchased it. And he's thinking, I can lock in a price and do something with it. Ethanol, I don't know what. You can't feed it to animals and do that. So somebody out there has the opposite point of view, and if the world global economy does improve, then we may look back at it and say, $4 corn, given the risk that we had, was probably cheap for the guy that wanted to use it, based on what he thinks is coming down the road in 12 months from now, basically, is what we're talking, after harvest next year. So, it's good to lock in a profit along the way, especially with our fertilizer prices dropping. I've applied all the fertilizer on my corn for next year already at half the price that I paid last spring for fertilizer. So I can make more money now at beginning at these prices than I could last year with even higher prices. Probably drop.
All right, that's Jerry Gulke. And Jerry, you're going to have a lot more on these bigger picture issues at the Top Producer Seminar coming up on your talk is going to be on the 29th of January, I believe.
Right. We'll have a lot of good information by then, again, from the government as to how they viewed this crop loss in the field, and if at all.
All right. That's Jerry Gulke, the president of the Gulke Group and Top Producer Marketing Strategy columnist. Thanks a lot, Jerry.
Thank you.